If you've ever sat in a finance office, you've heard about GAP insurance. Maybe you bought it. Maybe you declined it. Maybe you nodded along without really understanding what it was. GAP insurance is one of those products that can be genuinely valuable for some buyers and completely unnecessary for others. The difference comes down to your specific deal. I'm Gary, the bad credit car guy, 26 years in the car business. Here's what GAP insurance actually is when you need it and when you don't. It stands for Guaranteed Asset Protection. Here's what it does. When you finance a vehicle, the amount you owe on the loan and the actual cash value of the vehicle are two different numbers. And in the early months of a loan, especially a subprime loan with a high interest rate and a low down payment, you often owe more on the loan than the vehicle is actually worth. This is called being upside down or having negative equity in the vehicle. It's extremely common in subprime financing, and it creates a specific risk. If your vehicle is totaled in an accident or stolen, your regular auto insurance pays you the actual cash value of the vehicle at the time of the loss, not what you paid for it, not what you owe on the loan, what it's worth right now. Here's the problem. If you owe $12,000 on the loan and the vehicle is only worth $9,000 at the time of the accident, your insurance pays $9,000. You still owe the remaining $3,000 to the lender even though you no longer have the vehicle. GAP insurance covers that $3,000 difference. That's the gap, the difference between what you owe and what the vehicle is worth. If you have GAP coverage and the vehicle is totaled or stolen, GAP pays off that remaining balance so you're not left making payments on a car you no longer have. Here's how to know whether GAP insurance makes sense for your specific situation. You likely need GAP insurance if you put little or no money down. The less you put down, the more you finance, and the more likely you are to be upside down in the early months of your loan. With a subprime interest rate compounding against you, the loan balance drops slowly in the early months while the vehicle depreciates steadily. Low down payment plus high rate equals a high likelihood of being upside down. You likely need GAP insurance if you have a long loan term. A 72-month loan at a high interest rate means your balance drops very slowly in the first couple of years. Vehicles depreciate fastest in the first 2 to 3 years. The combination of slow balance reduction and fast depreciation creates a wide gap for a long time. You likely need GAP insurance if you're financing an older, higher mileage vehicle. Older vehicles depreciate faster and are more likely to be declared a total loss by an insurance company, the total loss threshold, the point where the insurance company decides it's cheaper to total the vehicle than repair it, is lower on older vehicles. You likely need GAP insurance if you rolled negative equity from a previous trade into your new loan. If you were upside down on your trade and that balance got added to your new loan, you started the new loan already underwater. GAP coverage is important in this situation. Here's when GAP insurance is probably not necessary for your situation. You put a significant down payment down, 20% or more. A large down payment means you start the loan with real equity in the vehicle. You're less likely to be upside down from day one. You have a short loan term, 36 months or less. A shorter term means your balance drops faster. Combined with a reasonable down payment, you may have positive equity relatively quickly. You've been making payments for a while and your balance has dropped below the vehicle's current value. Once you have more equity in the vehicle than you owe, the gap no longer exists. At that point, GAP coverage is paying for protection you don't need. You already have loan/lease payoff coverage through your regular auto insurance policy. Some insurance companies include this as part of their comprehensive coverage. Check your policy before you buy GAP at the dealership. GAP insurance is sold in a few different places, and the price varies significantly depending on where you buy it. At the dealership. This is where most subprime buyers encounter GAP insurance. In the finance office when they're signing their paperwork. Dealer-sold GAP typically costs between $400 and $900 and gets rolled into your loan. That means you're paying interest on the GAP coverage for the life of the loan, which increases the actual cost beyond the sticker price through your auto insurance company. Many auto insurance companies offer GAP coverage as an add-on to your existing policy. The cost is typically $20 to $40 per year, significantly less than dealer GAP. The catch is that some insurance companies won't add GAP after the policy is already in force. Ask your insurance agent about this option before you go to the dealership. Through a standalone GAP provider, there are third-party companies that sell GAP insurance independently. Prices vary. Shop around if you have time before your purchase. Here's my honest take on dealer, GAP versus insurance company, GAP. If your insurance company offers GAP as an add-on and you can get it added to your policy, that's almost always the better deal financially. The coverage is similar and the cost is dramatically lower. If your insurance company doesn't offer it or won't add it to your existing policy, Dealer GAP is a legitimate product that serves a real purpose for subprime buyers. Just understand what you're paying for it over the life of the loan. Here's the simple framework for GAP insurance. If you're putting less than 20% down, financing at a high interest rate, and taking a loan term of 48 months or longer, GAP insurance is worth considering. Check your auto insurance policy first. If they offer it at a lower price, add it there. If not, Dealer GAP serves a real purpose for your situation. If you have significant equity in the deal from the start, significant down payment, short term, or both, you probably don't need it. I'm Gary, the bad credit car guy. 26 years of watching buyers make good and bad decisions on products like this. Now you know how to make an informed one. Grab the free guide in the description, subscribe, and I'll see you in the next one.